Nvidia is up over 233% over the last year, and over the last 10 years, an astronomical 17,000%. And in today's video, we're going to find 5 stocks to outperform Nvidia and see exactly whether or not these are strong contenders for your portfolio. We're going to take a look at each of these, their historical performance over the last few years. We're also going to look at their dividend safety as well as diving into their financial metrics to ensure they are strong contenders with a lot of growth for the future. And as always, we're going to run them through the valuation model to get to the intrinsic value as well as the acceptable buy price given our investor margin of safety, and also see what Wall Street are forecasting for the next 12 months. And towards the end, we are going to take a look at a new semiconductor, SOXX, and look at this as an alternative for those who don't want to put too much risk in selecting semiconductors. So let's jump into the first stock. We have Applied Materials, ticker symbol AMAT. Now this is one very strong growth, up 74% over the last year. Over the last 10 years, 939%. Currently trading in the mid to upper end of the 52-week range with a yield of 0.65% and a PE forward-looking of 24.01. So in terms of their dividend safety, a score of 86, very safe. Market cap 164 billion, a mega cap company. Now in terms of those recessionary metrics, for those that see a recession inbound in 2024, well, they maintained the dividend 0709. They had below average growth, negative 38% versus the S&P's negative 12, and they had a near S&P return, negative 57 versus the S&P 500's negative 55. One thing we love about Applied Materials is their dividend growth. As we can see, 23% last March, very strong growth. We're expecting another increase over the next few weeks. Double digits over the last 5 years, double digits over the last 10 years, a very strong dividend growth company. We do note, however, they have been increasing those dividends for the last 6 years and paying a dividend for the last 18 without a reduction. As always, we do take a look at dividend yield theory. Now it states the company is undervalued when the current yield sits above the 5-year average. So what we have here is a sign of overvaluation, but do bear in mind we don't look at any of these models in isolation and conclude towards the end. Forward PE 24 versus 16.5, so again another sign of overvaluation on this, but a lot of things it doesn't take into account are such things like market conditions and the boom of AI that we are seeing currently in the market. Information technology sector is, however, higher at 27.5. So let's take a look at the payout ratio. As always, we do draw your attention to the free cash flow. Below 50% if we want to be industry specific for semiconductor firms. Nice to note, not only has it only been above that once, but it has been decreasing over the last 10 years. 13% in 2023, expected around 20, or in fact 16% in 2024, which gives me faith that we will see in the next few weeks strong double-digit growth to that dividend for AMAT. Free cash flow per share, nice to note, it has increased very rapidly over the last 10 years, 128 in 2014, 904 in 2023, although we can see a little bit of a drop expected in 2024 to just over $8. Sales growth, as always on the channel when we do our deep dives, we do look for steady moderate growth of 3 to 7%. Overall, very strong double-digit growth to their top line consistently, although we do see that drop in 2019. And we can also see that 2023 was their second worst year, and that retained around 3% to their top line, which as we can see is at the lower end of the minimum that we want to see. Numerically speaking though, nearly 3 times their top line from $9 billion in 2014 to $27 billion in 2023. One thing we love to see is when companies return excess cash to investor pockets through share buybacks. $1.23 billion in 2014, 842 in their latest report, so they are buying back a lot of shares. Do not discount this, as this is a way of returning a lot of excess cash to investors. Speaking of share buybacks, we have recently done a free newsletter article running through companies that return a lot of excess cash by aggressively buying back shares. If you want to sign up completely free by clicking on the pinned comment below, we are releasing a new article today and you have access to all of these other articles completely free. So let's take a look at more financial metrics. ROIC, I love this. I love it when it's above my minimum 10%, as that gives me faith that management are able to effectively allocate their capital. And I love to see it increase from such a decent position already. 34% in 2023, looking very, very positive so far. Margins for the semiconductor industry, nice to note, it is also increasing. They are improving their operational efficiency. 29% in 2023. Likewise on the free cash flow margin, lots to love about this company. 29% in 2023 as well. Net debt to EBITDA, so for those that are new, this essentially is the earnings before interest, tax, depreciation, amortization, and it shows us the number of years that it would take a company to pay off all of their debt net of cash on hand. Correlates to the balance sheet strength as well as dividend safety. 2023, it wouldn't even take them 1 day to pay it off. They have a very, very strong balance sheet, and that dividend, based on this information, plus the free cash flow payout, looks to be very safe. So let's jump into the valuation of this company. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we do run through every single one of these models. For today's episode, as we're going through a few stocks, let's jump straight into the calculation. And for today's episode of AMAT, the intrinsic value comes to $229. So the current price around $197, a margin of safety. As always, we start off with 10%, and we use this if it meets 3 criteria: a wide moat, strong financial metrics, good forward-looking data. So we can see up to 10%, a buy at 206. If we move to 15%, we can see it is around $2 shy. So we would say for today that Applied Materials has around a 15% margin of safety. In terms of Wall Street and their forecast over the next 12 months, well, they see a price target of $220 with upside of 12%, so they do see this as a fairly strong buy. One thing I would say when looking at Wall Street's forecast, they do tend to increase it every time the share price goes up, so I wouldn't say take a lot of this information, but it is always nice just to know what they are seeing as one level of our investment thesis and analysis. Moving on to the next company, we have Skyworks Solutions. Now this is down around 8% over the last year. Over the last 10 years, however, up 193%, and it hasn't got to its all-time highs of just under $200 in summer 2021. It's currently in the midpoint of the 52-week range with a nice starting yield of 2.6% and a fairly attractive PE of 15. So taking a look, the dividend safety score 68 looks to be safe. Market cap just under 17 billion, a large cap company. In terms of those recessionary metrics, well, they didn't pay a dividend, so no comparative data. They had above average growth, -7%, and they also significantly outperformed the S&P, -23 to -55. Dividend growth, lots to love, 9.7% in their latest increase of last summer, double-digit growth over the last 5 years, so looking positive for dividend growth investors, and they have been increasing those dividends for the last 9 years. Moving on then, taking a look at dividend yield theory, we have a sign of undervaluation on the yield, 2.62 versus 1.85, but we also note the forward PE sits not too far off that 5-year average of 13.6, and we can see it's significantly under the information technology sector PE. Moving on to the payout ratio, remember 50%, that will be what we'll use for today's episode as we're looking at semiconductor industries. Below 50% consistently, it has been increasing, but 2023's 25% and 2024's expected 35% is very reassuring. So I would be shocked again if we don't see a very high single-digit increase to the dividend or a nice double-digit increase. Nice to note that their free cash flow has more than 3 times over the last 10 years to 1020, but again we are expecting a bit of a drop in 2024's numbers to 781. In terms of the sales growth, well, whilst we do see some strong years of growth, double digits similarly to 2021, we do note 2022 it was around 7%, 2023 down 13%, so we can see why the share price has suffered slightly over the last year. In terms of the sales, though, numerically it has doubled, 2.3 billion in 2014 to around 4.5 in 2023. Shares outstanding, they've also done some share buybacks, reducing it from 193 million to 161. So again, positive to note as an investor or a potential investor. ROIC, nice to note that it is above the 12%. It has been decreasing from 2015, something to keep an eye on. Nonetheless, still very strong in terms of the metric for this year. Margins as well looking very positive on both the operating margin and the free cash flow margin. 24% in 2023, above that 16 minimum. Free cash flow margin as well, 34% in 2023. So this is a very strong company looking at their operational efficiencies. So when we now take a look at the net debt to EBITDA, 2023 at 0.38, 2024 at 0.11. Again, a very strong company. This is a very good metric to look at their balance sheet strength. dividend safety as well, but we can see that their balance sheet is looking very healthy. So in terms of the valuation, let's get to that. And don't forget, you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and on your watch list by clicking on the pinned comment below. So we start off with a 10% margin of safety, a buy up to 130, we then go to a 15% until we get to essentially roughly the current value. And we can see this does have quite a significant margin of safety. Not at 30% yet, but we believe 25 to 30%. It is a very strong company. And in terms of Wall Street, they expect upside of around 16%. So this does look like a good choice for you to dig deep and see whether or not this is one to consider for the portfolio. Intrinsic value giving around a 25 to 30% margin of safety, and Wall Street showing us 16% upside as well. They do believe this is a strong buy. As we go through these companies though, do drop us your thoughts in the comments below as to whether or not you are adding to any of these. And let's move on to the next stock, which as we can see is KLA Corporation, ticker symbol KLAC. Now it is up 72% over the last year, over the last 10 years, over 1,000%, very, very strong. We can see currently trading at their 52-week high with a yield of just under 1% and a forward P again of 29. So when we take a look at their dividend safety, a safe score of 71, a market cap of 90 billion, so it is a large cap company. And those recessionary metrics, while they maintained the dividend, they had below average growth, but they did in fact also trail the S&P with their negative 70% return. Dividend growth, lots to see. Very nice to know that all of these semiconductors are increasing their dividends for the large part double digits over the last 10 years as well, on average 13%. When we take a look at that streak, we can see 13 years of consecutive increases. Lots to love, lots to see as well. In terms of dividend yield theory, well, again, we do have that sign of overvaluation on the yield. 0.87 versus 1.34. Similarly on the forward P, sitting much higher than the 5-year average. But again, you do have to, 1, not consider these in isolation, and 2, bear in mind the market conditions. Information technology as well, pretty much bang on the same as KLA. So let's take a look at the free cash flow payout. Again, only 1 year above the 50%, also decreasing. 2023 and 2024 looking very strong and low. Therefore, it would be a very big surprise if this year we don't get a double-digit increase to their dividend. Free cash flow as well looking very strong. $4.29 in 2014, $24 in 2023, expected to go even higher in 2024. So again, whilst it may look, when you are considering some of these, they're overvalued based on different reasons. If a company is producing some very strong earnings, some very strong growth, then again, you could argue a lot of this is justified. Sales growth, double digits pretty much consistently, other than 2015. We do see a negative growth, 23%, or in fact 33% in 2022, 14% in 2023, looking very strong and healthy. And we can see that numerically their top line has more than tripled over the last 10 years, 10.5 billion in their latest year. They also do share buyback, so we can see this is becoming a consistent theme alongside all of the semiconductors that we have analysed, and their ROIC nonetheless looking very, very strong in the low 40s in the last 2 years. This is one of the things that you really do want to see when analysing companies, is a very strong ROIC number. As well, I mean, don't forget about the margins looking very positive, in fact increasing over the last 10 years, and that could be said and hold true for also the free cash flow margin. So lots to love with KLA Corporation. Net debt to EBITDA 0.61 in 2023, expected there or thereabouts in 2024. So again, the balance sheet is looking healthy, and based on this information and the free cash flow payout, that dividend also looks to be secure. How about the valuation? That is always important. Just because you identify a company that you want to add to the portfolio, it's imperative that you understand the valuation and making sure you buy at the correct price. So the intrinsic value is coming to $771, and our margin of safety, as we start off with, 10%. Up to 694, 15% we can see it isn't quite there yet. So for KLA Corporation, we see between 10 to 15% as a margin of safety. In terms of Wall Street and what they forecast over the next 12 months, they see this as around a $690 price target with upside of 4%. Interestingly though, we do see this as a much higher intrinsic value, and ultimately we do see the share price at some point catching up to the intrinsic value. The next stock that we are taking a look at is Lam Research, ticker symbol LRCX. We can see over the last year a strong performance, up 90%, over the last 10 years around 1,700. Again, trading towards their 52-week highs with a yield of 0.9% and a forward PE of 32. So in terms of the dividend safety score, it is 66. It does look to be safe. Market cap 122 billion, a mega cap company. They didn't pay a dividend, so no recessionary comparative data. However, they did have below average growth and also trailed the S&P during that period. Dividend growth, again, common knowledge, a lot of these are offering those double-digit increases year on year, so very nice to know over the last 5 years that dividend has increased by 22%. They have been increasing those dividends as well for the last 9 years. So let's take a look at dividend yield theory. We can see here that sign of overvaluation, 0.86 versus 1.3. Likewise, the forward PE sitting much higher than the 5-year average, and we can see just slightly higher than the information technology comparison. So in terms of the payout ratio, again, a lot of these metrics in the semiconductors do seem to be very similar. 20% in 2023, 26% expected in 2024. So again, it would be a surprise if we don't see some nice, healthy double-digit increases to the dividend. Free cash flow as well, nearly 10 times over the last 10 years. Absolutely phenomenal. But do note in 2024, we are expecting a little bit of a drop to $30.90. Sales growth, pretty strong across the board, although we do know in 2023 it is only 1%, which is a little bit different to the last 2 years where we did see strong double-digit growth. Numerically speaking, then, it has gone from 4.6 billion to 17.4. Again, common knowledge, as we've seen with these other semiconductors, they do share buybacks and they have reduced their share count, as we can see here, by around 41 million since 2014. Moving on then to the ROIC, again, very, very strong, 39% in 2023, in the high 40s the year before. And again, it has also been increasing, which is always nice to note, especially when it starts off at a very strong point as well. Margins, again, increasing. A lot of these semiconductor companies that we're looking at, their operational efficiency has improved drastically over the last 10 years. And as we mentioned, they already start off at a fairly decent position on both the free cash flow and the operating margin. Net debt to EBITDA, again, you can't pretty much get much better than this. 0.03 in 2023, 0 expected in 2024. So again, a very high quality when looking at their balance sheet. So let's jump into their valuation, see what we are working with in terms of that intrinsic value. And we can get to a value of just under $1,100. Now with the current price at $925, we use that margin of safety of 10%, $990. So over that price, then we move to 15%. And we can see a buy up to $935. At 20%, it isn't quite there yet. So we see between 15 to 20% margin of safety for LRCX. In terms of Wall Street and their forecast for this semiconductor, again, similar to KLA Corporation, upside around 4% with a price target of $960. Then moving on, we have the next stock, which is MU Micron Technology, up around 46% over the last year. Over the last 10 years, around 256%, and we can see its all-time highs not too far off, just under $100 around 2022. They also have a yield of 0.53%, and we can see, though, one thing to note with this company, it does have a negative earnings per share forward-looking of 37 cents. Now, this might put a lot of people off, but when we have been taking a look and researching, this was one of those top companies that they were saying to be one of the best semiconductors for the future. So let's try and understand why. Dividend safety score of 60, borderline safe. Market cap under 100 billion. It is a large cap company. Those recessionary metrics, well, we can see that they had negative 18%, so below the average growth. Dividend growth, they haven't increased those dividends since July 2022, and we can see they have only been increasing for the last 2 years. So let's take a look at dividend yield theory. So we have a sign of undervaluation on the yield, 0.53 versus 0.43. And we can see, though, that the sector P comparison, Micron of 48.6, is higher than information technology's 27.5. In terms then of the payout ratio, we can see in 2023 it looks to be negative, so they would have had that negative free cash. But we do see in 2024 it is expected to increase to 67%, which we can see is one of the highest, in fact, in the semiconductors when comparing it to the previous companies. The free cash flow per share has been pretty inconsistent, 245 in 2014, negative 560 in 2023, but we do see it is expected to bounce back into positives to 0.68 in 2024. In terms of the sales growth, again, very inconsistent. In fact, 2023, it did drop significantly, negative 49%, and we can see the current trend seems to be 2 years of double-digit positive growth followed by double-digit negative growth. So by that estimation, 2024 could possibly be a poor year. Numerically speaking, 16.4 billion to 15.5. In terms of the shares outstanding, well, it has gone from 1.2 billion to 1.1, so they have done share buybacks, although we do know overall they do sometimes do share issuances to dilute your position, but over the last 10 years, the net position is essentially buybacks. ROIC, again, we can see that is negative due to the information above, but before that, we do see it very inconsistently straddle around that 12% for the semiconductor firms. Operating margin, again, they did make that loss in 2023, hence why we see the negative number, and that also affects that negative free cash flow. But again, prior to that, not too bad. Some years where it does fall below on both the margin and the free cash flow. But what we are noticing, the theme here with Micron technology, that it is fairly inconsistent, or has been over the last 10 years. 2023 at 2.05 does bring it significantly above that 1.5, although the positive to note here is that 2024 it is expected to come down to 0.51. So what is the valuation on MU? Let's get to that intrinsic value and see what Wall Street are forecasting. And what we note here is that we can only essentially use the DCF model given the fact that it does have negative earnings per share. So let's talk about the essential current price. So $86 with our intrinsic value still showing signs of undervaluation. On that margin of safety of 10%, it is a buy up to $92. At 15%, $87, and 20% not quite there yet. So we see 15 to 20%, one of those that we have reviewed today that does have a fair amount of margin of safety. In terms of Wall Street and their expectations over the next 12 months, well, this is one that they do believe to have one of the most upside from those stocks that we have gone through, with a price target just under $100, upside of 16%. And as always, if you do want us to do a proper deep dive that we do on the channel of any of these stocks, do let us know in the comments and we can take a further look, especially with MU, given that there were some questionable metrics, to understand the reasonings behind why that is. As always though, if you do enjoy this content, smash that like button and hit that subscribe button so you are continually notified of these videos as they drop. Now on the previous episode when we did run through some semiconductors, we did take a look at an essential ETF which was SMH. Today we're taking a very brief look at another one which is SOXX, which is the iShares Semiconductor ETF. Now this is one for those that don't want to select their stocks just to reduce their risk, and the reward can also be fairly strong. We can see that they have exposure to US companies that design, manufacture and distribute these semiconductors. So in terms of looking at their total return, if you were to have held this just for 1 year, you would be up 67%. If you were to have held this over the last 3 years, we can see annually you'd be up 16%. And over the longer term, over the last 10 years, up 24%. Since inception, which is quite some time away, 11%, which isn't too bad as well. When we take a look for those that want to see what is held within this, well, as with the majority of semiconductor ETFs, Nvidia is the largest portion with a weight of 10.84%. We do have some here that we did discuss on today's episode: Applied Material, Lam Research, KLA Corporation, and we have also on previous episodes run through the other ones that you do see on this channel. So as always, do let us know your thoughts in the comments below, whether or not you like any of these semiconductors that we have run through, or whether you do prefer holding ETFs just to reduce that risk, and there is still a fair amount of reward. Don't forget as well, join that weekly newsletter completely free by clicking on that pinned comment below. As always, have a great day, see you on the next episode, and take care for now.